in my opinion, it's kind of BS because just because you've done well and you've invested, now they're going to put a second lien on your property. But if you had nothing and you were still a good borrower, they could make the loan. It's just the guideline states that if you do have it, they're going to have to take it. It's better to pay a little bit now than make a bad decision in the future, right? So that's why we always encourage people to get with professionals. Same thing with like tax questions. At the end of the day, I think everybody should try and legally pay less taxes and make more money. All right, everybody, we got a tiny group, but that's good. I'm just kind of a practice run anyways for what I want to do with this group, which is Business Ownership Launch is really kind of like an incubator to help people buy their first business, look into franchise, learn about SBA financing, pretty much everything you need initially to get the process rolling into the discovery of a business model. Most of us are looking at franchises. Obviously, the franchise models they vary. Their discovery processes vary. I know a couple of you here are going through discovery process, so I wanted to. I think this will be a good compliment because you guys are a little bit further ahead than many people that haven't yet started to talk to franchisors. So we're gonna walk through, and so the goal of this event is to one is to get a good high level overview of the franchise buying process to help you invest into a franchise model within the next 60 to 120 days. And at the end of the day, it's always on your pace. I mean, some people are very decisive when it comes to what they want to do. They make faster decisions. Some people need to look at several different franchise models or business models to really kind of find the one that works or resonates best with them. So it's always at your own pace. As always, anytime you want to get a hold of me, you can go to bookwithbeau.com and schedule a call. I'm always happy to walk you through as you're going through the discovery process. I'm going to send you resources. I know a couple of you here today are going through and you're getting franchise disclosure documents. I'm going to send you some resources that will help you review the franchise disclosure documents. I even have a franchise attorney who did like a 40-minute webinar on franchise due diligence. I'll send that out to you guys too, so you guys have that as a resource as you're going through. Because at the end of the day, it's all about researching and doing your homework. And I think one of the most important parts of the whole franchise discovery process is really not being afraid to pick up the phone and validate with other franchisees in the system. As you know, once you start looking through the FDD, it's kind of it's overwhelming because there's 200 or 300 or 400 pages, and you got to look at the item 19, the item 7, the initial estimated investment range. So there's a lot to it there. So as we dive into today's session, I've also put together a series of franchise models, short videos, just to walk you through some other business models that just give you a flavor of what's possible out there. If you haven't yet done your Zoracle, I know several of you have, then this would be relevant to you. What we've done is if you go to businessownershiplaunch.com/go, I ask a series of questions. These questions really are geared to helping in the process of identifying the right business model for you. Part of it is, are you keeping your job? Are you transitioning? Or do you plan on leaving the job in 12 months? Do you plan on staying there for 3 or 4 years? Because we really have to find a business model that can complement and work with what your current schedule is and lifestyle. So a lot of it comes down to your financial capabilities. If we're trying to utilize SBA financing and pair that with your equity injection, some of us have a little bit of capital, some of us have a lot of capital, some of us have money in retirement accounts that potentially could be rolled over using like a Rob's rollover plan. So we really got to, all of these components are important to really figure out what business models might work for you. And we're going to talk today about owner-operator versus semi-absentee versus a managed business model. And quite frankly, a lot of people come into looking at business ownership and they think that they can just invest money and it's going to run itself. And even if you get a managed model, it's not the case. You have to realize that this is not real estate. It's going to take work, but if you can develop the skills and you find a good franchise system, then that's going to help you become a successful business owner. But you're going to put in work, and we're going to discuss the different business models, why everyone should own a small business. Actually, we're working on a book that's covering this topic because at the end of the day, I have many, many, many conversations. Usually my calendar has at minimum 4 to 5 calls a day with aspiring business owners, real estate investors, etc. And really being a real estate investor and a business owner myself, looking into advantages that you have. And my brother, who I always bring up, is a perfect example, pays a considerable amount on his W-2 every year. I actually was reviewing a file for an SBA loan, and the guy is W-2'd and pays close to $1 million a year in taxes. And when you're W-2'd, you're pretty much taxed at the highest rate. So owning a small business in conjunction with a W-2 is very advantageous. We've had Michael Reeder, the CPA, on, and if anybody wants a copy of that interview I did with him, I think that will enlighten you in many ways. And so I am not a CPA or a tax attorney, but I do know, because I ask a lot of questions, that there's a lot of advantages to owning a small business. It's actually more, in my opinion, it's more advantageous to own a small business than to have like 1 or 2 rental properties. Because if you're not deemed a real estate professional by a tax code, there's no better that I've seen tax breaks than owning a small business. The tax code was really meant for small business owners, not for employees. So like, I think you have to have a mindset shift too. A lot of us, we feel secure with our jobs and so forth. But at the end of the day, if you really look and you look at how many hours you're putting in your job, you might be making a great salary, but you're paying, 30 or more percent into taxes. So owning a small business, you can definitely take advantage of a lot of tax benefits. And then the other reason too is when you own a business and you grow a business, you can at some point have a sellable asset that you can sell at a multiple. So it's just like doing a rehab on a real estate deal. I find a fixer upper. I'm buying it for $100,000. When it's fixed up, it's worth $200,000, and it needs $50,000 of work. So there's potentially $50,000 of equity. Well, same thing with a business. As you grow it, it's going to become more and more valuable. And ultimately, I think the first year of business ownership is usually the hardest year because you're learning systems and processes. But as you grow your business, you start leveraging too. You can bring in the right people. It's depending on the business model you have, it's really about hiring the right people, retaining the right people, and the marketing system. So when you're exploring franchises, a lot of those questions will be geared on like the business model itself and how the franchise itself will support you. And so that's where really why I go back to the validation calls of like, what are the struggles? What are the pain points of this business model? Those are really what you want to dive into, because I believe at the end of the day, everything we do is going to have a certain level of pain points. Like when I was investing out of state, I had brought this up on a podcast. It's like I didn't think about the pain points of having a property manager, and then when they do the work on the properties, they're charging a huge margin. So the real cash flow is gone. And if I ever need to go look at a property, I'm not going to go fly 3,000 miles. So I'm really at the mercy of the property manager. So to me, that became a pain point, and is why I'm selling my out-of-state rentals, because sure, I've done well on them, but I don't want that business model. It doesn't make sense for me. I'd rather own less stores closer to me going forward. So just as you're looking at these business models, think about the pain points and just know that there are going to be pain points. But all in all, I believe owning a small business is the best way to become financially free. So why a franchise? A franchise is a proven business model, or if it's an emerging brand, it is right. Let me kind of rewind here. There's really established franchise models where they have 100, 200, 300 units or locations. And then there's emerging franchises that are growing rapidly. And so a brand that has been around and has many locations, might be more stable. So some of us are looking at some of the bigger brands that are larger conglomerates where they own multiple franchise business models underneath their umbrella, and they've been around and they have proven business models. So those type of business models could be a lot more secure than a more emerging brand. Now, why would you want to invest in a franchise that might only have 5, 6, 10 locations? Because you get a lot of the it's got open real estate, right? Like you have big territory. So some franchise models, I go in to see if there's territory checks, and there's no available marketplace. So there's a happy medium about what you want to get involved with, whether you want a really established brand or you want to grow with an emerging brand, and just understand the differences that you might have, where some of the brands have been around for 15 or 20 years. They're very established. Their marketing is maybe more established. And some of those bigger brands could be on the decline versus emerging. So you want to look into all this. But essentially, why a franchise? Proven business model, brand recognition, training and support, easier access to financing, collective buying power, marketing assistance, networking with other franchisees, reduced risk of failure, territory. You get your designated territory, so like that's your market, and then you're also getting the benefit of a brand and the brand recognition. Or if it's an emerging brand, you're getting a larger territory where hopefully that brand will bring in more and more business as it grows the name. It's a quicker ramp up than starting a business. So if I wanted to start a tree trimming business, it'd be extremely difficult to figure out the systems, the processes, what machines I need to do, how do you bill, how do you market? And so really, that's really the name of the game with the franchise. And so many people that are in corporate America, this is their real first business. Sure, they might own some real estate and they're investing in different things, but running a business is a completely different thing. And I think having systems and processes and a support infrastructure really make the difference on a franchise. And you don't have to reinvent the wheel typically. And then it's just a component of being able to find a business model that it makes sense. Because remember, it's not you that's painting the houses, right? It's unless you're an owner operator and that's what you want to do, you're the owner of the business, and you're the person that's going to be orchestrating the business and hiring the staff. Now, we also have business models that don't have a lot of employees. There's really a business model for everybody. We have consulting franchise models. There's vending. There's all sorts of business. So many people like the home service industry because generally it is low overhead, potentially high profit margins, and it's really simple. A lot of times you don't need a brick and mortar location. So many of the candidates I talk to really seem to lean into home service business models, handyman companies, plumbing, drain cleaning, HVAC, painting, tree trimming, garage floor, everything that goes into a garage, the cabinets, the flooring. There's franchise models that do deck building. There's franchise models that do tiny home sales, and they help people build ADUs in their backyard. So there's really franchises for everything. There's business service franchises that we have one group that we work with. They have an expense reduction company. So they go in and you can become a franchise within their system, and you help business owners reduce their expenses. And so there's all different systems, all different processes. And so that's why I think a franchise stands out to me, that I can invest in a model that's got systems. I'm not reinventing the wheel. Usually it's faster ramp up. And sure, at the end of the day, it's still a business. And do franchises fail? Of course they do. There's like, once you guys get really heavily into the FDD, you're going to look at the FDD. You're going to look, what's the retention rate of the franchise? There's going to be failures in every business model. There's failures. But I believe there's less failures definitely in franchise models versus startup businesses. And I don't have the statistics on that, but I would probably say that would be the case. So really, when you find a business model that resonates with you, where you like what they're doing, it's innovative, that's where I think you need to, lean into and start doing your due diligence on those franchises. So the franchise research process, this is really kind of how our team works. Usually somebody's interested, they reach out, we have an initial conversation. From that initial conversation, the candidate takes the business assessment, aka the Zoracle profile. We ask a series of questions, and from there we create basically a business model, like a business thesis, which helps us figure out what franchise models to show you. Also important in the beginning stages is really understanding the funding. And later on today, we're going to dive deep into SBA financing. Actually, that's how I got into the franchise space, is because I have a lending company and a franchise consulting company, but people would reach out to me and they were wanting to finance their franchise startups. And I would always ask them, well, why do you want this pretzel franchise? I mean, to this day, this still happens. And they're like, well, we like the pretzels. So then I discovered this whole world of, the franchise consultants. And after talking to numerous people that were just really finding a business model online, like a franchise, and then just calling and like just exploring that one particular franchise without any of the business model thesis, the business assessment, I realized that there was an opportunity there to use my skill sets with my financing background and understanding how to finance the franchise. And then I dove into the world, and I'm a member of FBA, which is Franchise Brokers Association. And we're constantly 3 times a week, we're learning about new brands. We're looking at different business models, etc. Understanding your funding too is very important. Are you doing a Rob's rollover? Can you do a HELOC on your house? What's going to make the most sense? And oftentimes, early on, I might suggest talking to like a Michael Reeder, who's a CPA. What business entity? What structure? You may have a couple $100,000 in a retirement account. Is it eligible for a Rob's rollover? What are the drawbacks, the pros and cons of using your retirement to do a rollover? I think this is all important to understand your buying power. So you know what you're not looking at something that's going to stress you financially. You're looking at something that's very feasible. So after we get all that done, we usually do a business model review where we look at 5 to 9 different franchise models. We usually encourage you at that point to, like, we want you to figure out of those 6, 7 franchise models, which 3 did you like? Rank them from 1, 2, 3. And the reason we always want you to talk to more than one franchise is because the third one on your list could be the one that actually makes more sense for you from a business perspective. Because remember, it's really not about what you're doing with the business work, because you're really just the business owner that's going to make the thing work. So a lot of people get turned off with these boring businesses like junk removal and things like that. But those businesses could be ideal for you. So I encourage everybody to look at the functions of the owner, and that is more important, I think, than actually what the business does. It's really the functions and doing that business. Would that make you happy, and would it help you reach your financial goals? That's really, I think, more important than the actual painting or the HVAC installation. So after you look and identify 3 of the franchise models, we're only up until then, we're only really talking high levels. We're showing you videos, things like that. So then you're going to talk to the franchisors. You're going to say, okay, I like this HVAC company. I like this tree trimming business. I like this restoration company. You're going to be introduced to the business development person at that franchise company. They're going to give you a deep dive, usually 30 to 45 minutes. And after that deep dive, it's okay for you to say, look, it's not right for me. But if you liked it, we encourage you to keep going down their process. All the different franchisors have their unique kind of process to help you get to a decision. And the decision at the end of the day is going to be, look, I went through validation with the brand and it doesn't validate well because the marketing, people were saying the marketing isn't great and I need marketing. So that's where we go back to the validation process. It's very important to be doing these calls. After that, we're looking at due diligence. The due diligence of the franchise model is you're going to get, after the initial call with the franchisor, they're going to send you the FDD. By law, there's a waiting period before you could ever sign a franchise agreement. So they send it out right away, and then they usually set up a follow-up call to go over the unit economics and the FDD. And so I do have a guide, and I'm going to send that out to everybody. The FDD, and then I also have a PDF that goes with it. So I have a 40-minute video from a franchise attorney, which is more high level. So towards the end, we always encourage everybody to, when you're down through the process and you're excited about the franchise and you want to potentially sign a franchise agreement, we always encourage you to have a franchise attorney review the franchise agreement. And the franchise agreement for a very established franchise model, they're typically not going to make many concessions because they have 200 other locations. If it's an emerging franchise, there's more concessions on territory and so forth, right? Because they're trying to grow their brand. So with more of the emerging brands, you sometimes can get different concessions. But I think with established franchise, it's really the component of the franchise attorney is to just highlight anything that could be a concern, so you can dive into it. Because many of us have never reviewed a franchise agreement or an FDD, so we would encourage you before you sign to invest a little bit of money and get a franchise attorney. The due diligence process is a combination of several calls with the franchisor, several validation calls. And one big component that I've realized with my background in finance is that one of the most important things you can do for due diligence, I believe, is when you're applying for an SBA loan, the banks always give you projections, and they give you a projection template. And the projection templates, I feel like, is one of the best ways to do it. So you're putting, SBA loans want 24 months of projections for a franchise startup. So broken out month to month. So as you're doing this drill, you're really learning more about the way this franchise could perform. What is the average ticket price? Let's say we're doing handyman business. So you might not be able to figure out based on the FDD on the item 19, what the average service call is. So we own a handyman company. Every time I go on an appointment and we get the job, the average ticket price is X, right? So we're going to start. These are the questions you really want to know anyways. So a lot of people bypass the projections, like I don't want to do that, this and that. But it's really what I believe one of the most important parts. So I do have projections. So how I help in the funding is I am not the lender. I just work as an advisor. So I'm going to help guide you to the right bank. So a lot of people say, I'm just going to go to my local bank. Well, that's a bad move for SBA financing. You want to go to a bank that has an established track record in franchise startup financing. So like when somebody comes to me and they want this or that, I know the banks to go to. I can help you kind of navigate the process. And there's really a handful of banks that are really good in the franchise startup space. And we use some of them for some reasons, and we use others for other reasons, which we can get into later in this call. So we're talking about due diligence, and I've already kind of beat up validation, how important validation is. You really got to do your calls, guys. You really got to build relationships with the franchisees you're calling, and really try to get in there. And going back to the projections, a lot of times I say, okay, look, I'm not sure what it is for an average ticket price for the handyman business, but once you find out, and they say an average service call is $421, then the next question is, how many service calls can one technician usually do in a day? They can do 6 to 8 or whatever, right? See, these are the questions you really need to find out, because that's important, right? Because then when you're doing your projections, you're like, okay, every service call out we get, that's about $421 average ticket price. If I can do 6 to 8 of those a day per truck, right now you're building out your thesis, and that's why the projections are so important. So after all this, everything looks good. You've done your validation. You're feeling really good about making the investment into a franchise. You go to Discovery Day, and Discovery Day is basically when the franchisor meets you in person, gives you a day in a life at the corporate office. You get to see more. You get to kick the tires. This is a very important process too. But Discovery Day, it's not a one-way street. So if you're not prepared to go to Discovery Day, they have to award you the franchise. Meaning, like, if you go there and you're not representing how you represent yourself over the calls, they might not award you the franchise, because they don't want to put somebody that's going to be a problem in the franchise system, right? Because their goal as a franchise, as a ZOR, we call them ZORs, their job as a ZOR is to get you guys kicking butt, and because they make more money and you make more money, and they're trying to avoid having bad apples in the group. So I had just heard through another gentleman I work with, he was working with a gentleman, and it was his time to go to Discovery Day, and he brought his wife, and they had never talked to the wife, and the wife went to Discovery Day and basically said, "Oh, I'll be running the whole business," and she really didn't present herself well, and they declined them from owning this franchise system. So it is a two-way street. Most of the time, if you're getting to Discovery Day, they obviously think you would be a good fit, but occasionally people get declined for different reasons. So just be aware of that. It is a two-way street. And then the decision happens, and so during this whole time, you're working on your loan. You're doing your due diligence. If you need a brick and mortar location, you've started to look for that. I mean, you really you understand the training. Each franchise system is going to have a different training program. So you really, do I fly to you? How many days do I spend there? What will that look like? What does ongoing support look like? Is there also video training? Understanding the marketing component. I think like everybody's going to tell you all the franchise systems are going to always tell you what they can do. This is what we do, but I also really kind of dive into the marketing system. So you really, at the end of this process, which can take several weeks or months, you really just want to make sure you've really looked under the hood of the car. You've taken out for a test ride. You slammed on the brakes to make sure it was safe. You've done all that stuff, and then at the end of the day, sure you're going to be nervous. It's common. Like it's kind of a scary process. Just like when I remember when I was flipping my first house, and it was a big remodel, and I was like, I don't know if I could do this. I don't know if I can. I don't even know construction. Got to hire the right people. Same thing. You're going to have a little bit of doubts, but I think at the end of the day, you have to take educated risk, and you have to bet on yourself. And that's why I think everybody should own a small business. And some people might say, look, I just don't think I want to own a business with all these moving parts. That's also fine. There might be a consulting type of business model that might be a better fit, or there might be a business opportunity like vending that might be a good fit for you. So I believe there's a good fit for everybody, and there's a good use case for everybody, depending on, is it more of a tax play, a tax strategy play, or is it a play to get out of the job as soon as possible and own your business, or is it an investment in your portfolio? There's all different use cases for owning these types of businesses. We're going to get you guys out earlier today. We still have a while to go, but I'm not going to hold you up too long today. I want to give you a deep dive. So overview, who is the SBA? The SBA is backed by the federal government. They've been around for many, many years. I can't remember when they started. I'd have to Google that. I forgot. But essentially, the SBA does not make the programs. They set up the guidelines. I mean, they set up the guidelines. They don't make the loans, right? They have all the banks, credit unions, and non-bank SBA loans. You have to be approved, licensed by the SBA to be a preferred lender. You could be a non-delegated lender too. So many banks don't have the PLP status, and they can send files in. But the banks we primarily deal with are PLPs, meaning they underwrite, they do everything in-house. You don't need to send the file to the SBA. The only thing we do with the SBA is get a E-Trans number, which is a case number. And so the reason the banks and credit unions and non-bank lenders like making these loans, because a big portion of it's guaranteed by the federal government, but also it's extremely lucrative for them. Many of these lending institutions sell off the guaranteed piece the day the deal closes, and they make a lot of money on that. So like, remember that they're spitting out SBA loans, selling off the government guaranteed piece the day it closes. And so it's a huge revenue stream for them, especially 7A versus SBA 504 loans. But at the end of the day, SBA loans, in my opinion, are the single best vehicle for entrepreneurs in the United States. So if you're a U.S. citizen or a permanent resident, you could potentially be eligible for SBA financing. You have to be either one of those. You can't be on a visa or a non-permanent resident. You can finance just business acquisitions. You can finance startup businesses like franchises. Franchises are actually a lot easier to finance as opposed to like just a normal startup. That's another advantage that I didn't dive into. Because these models are proven business models, they're much easier to finance with SBA. And so many of the banks that I work with have divisions that's all they do is franchise. They have franchise underwriters. They The SBA also has a directory with a franchise directory where they have a list of the franchise companies and whether they're approved to be if they're approved to be SBA financeable. They discontinued the directory, but everybody still uses the directory pretty much. And then we also use a data point called FranData for these franchise models. And so there's the SBA 7A loan, which most of the loans you're going to get are going to be for franchise startups are going to be 7A. There's also an Express, and SBA Express is very similar to a 7A. There's really no difference. And so any loans under $500,000, we don't need additional collateral. So if you keep the loan amount under $500,000 on a franchise, let's say a franchise startup, we don't look for outside collateral. If the loan amount is greater than $500,000, the SBA guidelines require us to look for additional collateral. So if you own a primary residence or rental property and I did $1 million loan for you and there was a collateral shortfall, which if it's a business acquisition with no real estate, there's going to be collateral shortfall, we would have to secure an equity, a lien on those homes to make up for the collateral shortfall. Depending on the bank, for the smaller SBA deals, I have a bank that I can usually close deals in like 3 weeks. They're the fastest SBA bank, but they're all small ticket. So if you're doing a bigger project, then we're probably not going to use that bank. A bigger project, most of the time on bigger projects, I work with 2 different banks. And on the bigger projects, over 250, over 350, they usually want, most of the banks usually want 20% of total costs down. Not all of them. But the small startup deals, I can do 90% financing on. But depending on the situation, we work with tons of banks. So we can navigate and figure out how to make the deal work. Most of the time, if you have decent credit and you have good borrowing characteristics. There's certain caveats you got to be aware of. Most banks won't make a loan to you if you, let's say I live in Las Vegas and I want to buy a franchise in Northern California. It's way over 2.5 hours. They usually want to see a business that's within a 2.5 hour radius of where you reside. If that's not the case with all the banks, there's no set guideline on that, but most banks, what I call, they overlay, and they'll have those restrictions. Like for example, Huntington Bank, if you're not in a 2.5 hour radius, then they want to know you're moving there. If you're not moving there, they won't do the loan. I have other banks right now. I have a gentleman he's in Washington State, and he wants to buy 5 territories of a painting franchise in another state. And most banks said no. I have got it with an underwriter with a bank, and I'm crossing my fingers we can get it done. Because at the end of the day, some banks make sense lenders. They're going to go off the SOP from the SBA, which is like the underwriting guidelines. And if you can make compensating factors, first of all, this guy is financially secure. He's got good outside income. He's got good credit. He's got experience running a business remotely. So those were my compensating factors. Now, some banks have rigid guidelines that they just won't look at that deal. We can usually navigate and find our good fit no matter what, because on a constant basis, on top of looking at franchise models, I am looking and talking with bankers. I'm in networking groups with different SBA banks. So that's how I figure out how to maneuver the SBA world, because I also help people do hotels and motels, campgrounds, RV parks, all that kind of stuff. So the advantage of SBA financing is high leverage. You'd never be able to get this kind of leverage from a bank unless it was partially guaranteed by the government. So you can have a total of $5 million aggregate SBA financing. So in one NAICS code. Before it could just be $5 million period. But now you can have, let's say you were investing in a restoration company, and you opened 5 territories, and you now had $5 million of SBA financing under that restoration company. Well, you're tapped out in that business line. But let's say you went and wanted to start a painting company. Well, that's a different NAICS code. A NAICS code is a classification that the government uses on different business industries. So you can have 5 million aggregate in the painting company too. So really, you're probably not going to run out of runway. Now, some of you eventually, when you start your big conglomerate, let's call it an HVAC company, and now you want to buy a building. You've had the business for 3 years. Well, as long as you occupy at least 51% of the space, you can buy real estate with SBA 7A. So there's a lot of plays because a lot of us here on the calls we're real estate investors too. So look, big picture. Hey, I can own this building now, and I can take advantage of the appreciation of the building. So we can finance up to 100% for an established business that is looking to buy a piece of real estate for their business. So 100% financing. Now, let's just say you have your restoration company and you're crushing it, and you've now filed 1 solid year of tax returns for that business, preferably 2, but with 1, now you want to open another territory. You're in Las Vegas, and now you want to move out to Henderson or to Arizona. Same business model. You can actually get 100% financing on expansion financing for franchises too when you're established. So really, I look at all of this as a big puzzle. And if you put the pieces together, you can really grow a fantastic business utilizing SBA financing. Now, the rates are tied to, on the SBA 7A, the rates are tied to Wall Street Journal Prime, which currently is 8.5%. I think 2.5 years ago was at 4.5%. As we know what happened to rates. Now, Wall Street Journal Prime is not tied to the same index as like the mortgage rates. So your Wall Street Journal Prime, which is currently at 8.5%, plus a margin up to 2.75. So today, worst case scenario, rates 11.25. On a business loan with no real estate, it's 10-year term, no prepayment penalty. If you're a really strong borrower, and you have more money to put down in the deal, we do have banks that will do much better margins. And so instead of a 2.75 or 2.5 margin, if you had like 30% of total project costs, you could potentially get a better deal. Now, if you're doing tiny 200,000 or less, a lot of the banks like to play a little bit bigger, so you're probably not going to get a smaller margin than somewhere in the 2s. But if it's a little bit bigger project cost, we do have banks that will give you a little bit better margin. They're usually portfolio banks, meaning they're not selling. Remember how I told you they sell off the guaranteed portion the day the deal closes? The portfolio banks keep the loans on their books, and they don't sell off the guarantee portion, and so they can give you a little bit better margin. Are there fixed rate options for 7A? There are. They're very far and few between. Most of the loans you're going to get are going to be variable. So when Wall Street Journal Prime changes, your rate's going to change. I think I covered most of these. Now, on a real estate deal, you can amortize the loan as high as 25 years. Let's just say you're a little light on reserves and money to put down. You can get a gift from a family or friends, or you can potentially bring in an investor partner that owns less than 20% of the business, and they don't need to be a guarantor. All these loans require a personal guarantee, just to be make sure you guys know that. At minimum, you need 10% equity injection. SBA of 504, it's 2 loans. The first loan is a conventional loan. The second loan is the SBA guaranteed piece. So on $1 million deal, 50% of the mortgage, so $500,000 would be the senior loan, $400,000 would be the SBA piece, and 10% equity injection. On a startup business, you get a 5% haircut, and if it's a special purpose business, you get another 5% haircut. So if it was a startup, you're going to get 85% of total costs with an SBA 504. SBA 504 is only good for real estate type deals or large machinery. You're not going to do just business acquisition. It needs to have collateral with these type of loans. With the 7A, you can do real estate and you can do non-collateral based deals. Like I have people buying businesses for $3 or $4 million and there's no collateral to it, still able to get them done with the 7A. I mean, because the cash flow from the business is strong and so forth. 7A versus 504. Most of us we're talking 7A today, but I just wanted to, with 504 loans, we could do large deals. We can do up to $16, $17 million deals. between the first and second lien. All right. Just to go back and talk about the business ownership models. Owner operator, pretty self-explanatory. Semi-absentee. Most of us are going to at least fall into the semi-absentee category, unless you're diving right into the business. But as a semi-absentee owner, it's still a business. Most franchise concepts, when you're validating, are going to tell you, you're going to devote at least 20 hours a week as a semi-absentee owner. And a lot of that component is really, hiring the right fit. So I've got several people looking at some different HVAC models. One of them is very busy with his corporate job, very successful, and his whole thing is being able to find that right talent for that semi-absentee role. Because any of these service-based businesses, really, you're gonna it's a machine. You're gonna have to be driving it. So, like, if you're still in corporate world and you're planning, just understand that component and really make sure you do your diligence and see what kind of help the franchise system is going to help to identify the right candidates for you to hire, and then also, as a business owner, you're going to have to learn leadership, all those components that go around with owning a business. As we kind of wrap up for today, if I'm not already helping you, you can go to businessownershiplaunch.com. There's a business assessment. It takes you about 10 minutes to complete. You can complete that. And you can also go to businessownershiplaunch.com/go. And you can answer that questionnaire, and then we'll meet after that. That just gives me a little bit of background about you, your potential financial capabilities, and it also gives you some drop downs as far as different sectors. There's well over like 20 categories of franchise models. It's not all home service. There's business to business. There's advertising type business models, education, childcare, health services, senior care, senior living, obviously vending, and the list goes on and on. So just trying to identify, a business model that might make the most sense for you is kind of the biggest component as you start going through the validation process. Happy to answer any questions on financing, on franchise process, etc. So let's just say, your total project costs are, say, $650. So we take $650, and on something that big, you're probably going to anticipate 80% loan to cost. I mean, we may be able to get you 90, but just realistically 80%, right? So 80% would be 520. So what I would do there is I would just make my loan less than 500, so they don't have to look for additional collateral. So if the loan stays under 500,000, they don't need to look for additional collateral. Now, kind of a workaround, I'd have to just check on this. So one of the banks we work with, on top of building in working capital into the SBA 7A loan, they'll also give you a line of credit. And I have to see if collectively you stay under that. They can give you a line of credit up to 100,000. I have to see if that would trigger the collateral shortfall, but that would be a kind of a sneaky way around not having to put up additional collateral. But in general, the loan amount's got to be under 500,000 because SBA guidelines say if there's a collateral shortfall and the loan amount's over 500,000, we have to look for additional collateral to make up for that shortfall. Say you live in Texas, they have the home equity laws, so they couldn't do it in Texas. But if you had a rental property, they would put a lien on a rental property. But in Texas, because of the home equity laws, they couldn't do it by law. But if you're not in Texas, they don't have that to cover you. So just, as I tell people this, just be aware, some of the strategies that some people say, I'm not saying to do this, but some people put equity lines of credit on their rental properties and things. So there's there's not a lot of equity before they apply for a loan. Not to tell you to do that, but people always ask, and I see people are trying to do that stuff sneakily. Not sure that's a good move, but people do that. But I just want people to be aware of what they'll look for. And let's just say you didn't own any real estate, they'd still make the loan. And it's kind of, in my opinion, it's kind of BS because just because you've done well and you've invested, Now they're going to put a second lien on your property. But if you had nothing and you were still a good borrower, they could make the loan. It's just the guideline states that if you do have it, they're going to have to take it. So let's just say franchise fee, working capital, you're buying 3 trucks, and that total cost and office space for the first 6 months, employee salary for the first 6 months. Let's say that equals $650 of total project costs. The most banks will lend 80% of that $650. We have a bank that will do 90% financing on those smaller ticket deals. So depending on what you end up doing, there'll be a bank that will be more beneficial for one way or the other for that particular deal. Some banks, if you're doing a brick and mortar location, don't like to do tenant improvement loans. Other banks will do all the funding for the construction. So it just varies. But based on like if we look at a tree trimming business, right, and you have those machines that you're going to buy or finance the trucks, and you do it one way, your total project cost is going to get up there. So when you're looking at this, and strategically trying to figure out, does it make sense to lease the trucks or buy the trucks? Maybe buy one truck because of you want the tax advantages for the depreciation. So that's when I would hone in and get with a CPA too, to see what makes sense from a taxation standpoint, to see if you can offset some of the W-2 income, and then keep the loan under $500,000 if you have rental properties that are owned in your name or a business entity that you have controlling interest in. Then they would look to put a lien on it. Like if you're invested in a multifamily deal with multiple owners, they can't put a lien on that. But if it was just you or your spouse, then they could potentially. Yeah. So that's what it would. But in Texas per se, if you just owned a primary house, because of the Texas equity laws, they couldn't put a second lien on it, right? To see if it's a good fit. And then at some point, yeah, you might say, look, it's just, from what you're telling me, it's just not going to work because I can't. I'm not leaving my corporate job right now. And, in 12 or 18 months, if this ramps up fast enough, I would consider it. But I'm not going to tell you I'm going to do it today because I'm not. What I do, we don't make earnings claims. So all I can do is give you advice on how to figure out earnings. So with the FTC, Federal Trade Commission, nobody can make earnings claims. That's against the rules. All I can do is have you call other owners and do projections. That's the best way to figure out earnings claims. And then if you're looking at a franchise model, you can look at their item 19. But nobody can make the franchisor, nobody can make earnings claims. The only thing they can say if it's on their item 19 in the FDD, then they can tell you those numbers, which you heard some of them on some of the videos. That's the only way they can do it because if there wasn't rules, people would go out and say, hey, you're going to make, $5 million, selling whatever widget. And that wouldn't be right because people would invest. So they have certain barriers where you just can't disclose certain things. But what I always tell people, and I kind of went into this a lot. The biggest thing you can do as you're doing your due diligence is once you understand the business model to a certain level, and start writing down questions you have. And then when you're calling other owners or franchisees or owners of these vending machines, what are you getting? What's your average vend? What's usually the price? How many vends a week are you averaging on your machines? How long did it take them to place the machines, right? These are all questions and the diligence you should do because you're making the investment, not me. And so I can't technically make an earnings claim, nor would I want to. But I would give you a projection worksheet and give you the questions to ask. And then you would do the drill and then you would figure out if it's a good investment or not. And that would be actually the best thing I could tell you to do because that's how people really understand if it's a good business model or not from the outside, right? And so once you did that drill, you would know if you'd want to buy it or not. A lot of people are happy with the business model. I'm sure there's people that are unhappy. In general, it's the whole 80-20 rule. There's going to be 80% of the people in high level that will be remotely successful with the business. They're making a living. Probably a 20% failure rate because they didn't operate the business efficiently. So in any business, there's going to be, and so in an FDD, when they do make earnings, some of them will post their earnings. They're not claims because they're going off what their actuals are. you'll see like the top 25% of franchises did X amount in revenue, and and the bottom did this, and the medium did this. So I said, always make sure you're running your numbers that you're going to do an average job, even though I know you all do an above average job. So you'd be realistic with your expectations. And so that's part of this, why I wanted to do this, is like to let everybody have a baseline of understanding of how to start doing due diligence to make sure that whatever investment they want to make is an investment that they can do as much homework on before making an investment, because there's no sure things in life. That's for sure. Right. We've all probably, if you invest in real estate and you've flipped houses, if you flipped over 5 houses, you probably haven't made money on all those houses. You probably lost on one of them or broke even. Like it's just the way things work. So, when you're looking at franchises, what's their track record? If it's a more of an established franchise, there's going to be more people to validate with. If it's an emerging franchise and they have less locations, could that be construed as a little bit riskier? Of course, because there's less. But could there be a lot more opportunity? Of course, because there's wide open territories. So these are all things you want to consider. But what I would say is that Naturals to Go does have a large track record. They've been doing it for about 14 years. So I would say that if you went through the diligence process, it would answer a lot of your questions, understanding that marketing component a little bit more, because that's really what's going to drive you initially until you start getting revenue. So like, I think from that side, the other thing too with an emerging brand is that the good thing, I think, is that like they almost have to be more invested with you, because if you don't do well and you're one of the first franchisees, then they're not probably going to do that well, because they're not going to validate well, right? Like if you do really well, you'll be the a poster child for them. And so I would think they would have to invest more time, and then also early on you'll probably have more access to the founder, which would probably be extremely beneficial. Like versus if they had 100 locations, you're not going to get as much screen time or phone time with that person. So I think that would be a difference. And then then you hedge the pros and cons, and then okay, I like the business model, and it is a good industry. And then you really understand the component of like, okay, I start with one truck. I think you could have 3 technicians in that truck, and like, okay, how much are you billing per hour? How are you getting those first jobs? And then at what point do you get truck number 2? And then at what point do you bring in the next service line of the pest control or whatever they do next? And then how does that incorporate in? And then because this is how you're building your projections for SBA, and then you're going, okay, well there's I forgot what the numbers they were looking at, but like that one truck, once you get to 80% booked, then I think they say, okay, now you're looking to get that second truck going and scheduling out for that. And so understanding how it grows too. And then going back to your original question, I think, yeah, like a lot of these brands, when I was searching for you, for example, like because you're in a pretty popular market, they're going to be sold out, right? So like if you can plant your flag in a big territory, and then years to come, I mean, it would take them probably some time for them to expand, but then you have a huge territory, which is great for market share, because you're in a market where there's a lot of growth and things like that. So it could be beneficial for you. Doing that now is better than waiting to the end, because it's going to help you do your analysis of the validation that you like this brand and you've done your numbers, and it'll help you come up with questions that you wouldn't have thought about until you did this. So if you wait to the last minute, you're not coming up with the questions. And so that's why I encourage people to like do it early in the process, because then you're going to come to a conclusion a lot faster, because you're going, okay, like if the average, job is $1,500 or $1,200, okay, how many jobs you could figure out the ramp up of this business. And then you're going to look at your overhead, and you're going to have all these numbers. And then you're going to go, wait a second, I don't know this. I need to ask this question to another franchisee or corporate, because I don't know what the insurance cost is going to be roughly. Mm-hmm. And now I'm going to go get a quote now. And then, So you're more prepared when you get to the discovery day, and then you get the discovery day, and I think you'll have a better versus kind of rushing into it and then like, oh, I don't, I'll get somebody else to do the SBA projections for me. I'll pay somebody. Versus it's like important for you to know, even if you hate spreadsheets. I'm like, it once you start doing it, it's actually pretty easy, and then you'll get a lot of unknown questions answered that way. It's better to pay a little bit now than make a bad decision in the future, right? So that's why we always encourage people to get with professionals. Same thing with like tax questions. We like Michael Reeder. He's one of our guys we like to work with. He's a good CPA, so he specializes with small business owners. So there's a lot of like I can talk about like Section 179. I don't understand it like he does, but high level I could say, yeah, there's tax write-offs. Go talk to him about like, what if I buy these 8 vending machines and it costs this much and I make $150,000 on my W-2 and I have no other write-offs, what would that look like from a tax savings perspective? And that's what a guy like he could do for you. At the end of the day, I think everybody should try and legally pay less taxes and make more money, right? Like that's what we should all try to do. And so we have to get the right people around us that can help us do that. So anyways, I hope everybody enjoyed and enjoy the rest of your weekend. And you can go to bookwithbeau.com. You can schedule a call with me there. My email is beau@beaueckstein.com. And then you can also go to beaueckstein.com/events. And then there's a bunch of events that I'm doing. June 29th is Business Ownership Summit. That's where we have CPAs talk. And June 29th, that'll be a good one. We've done one of those before.